Welcome to the daily update, where I'll go over the action in the market for Friday, September 6th, and then we'll see how things look for Monday, September 9th. Okay, we have switched over negative now. We were leaning that way, going back as far as last weekend. That's why we look at so many different charts and analyze so many different things. We saw some weakness starting to come in. We shifted over and looked weaker. Well, now we are pretty much straight across negative in the short and intermediate term. We're still positive in the long term. We were watching some moving average studies as well as some moving averages, and those support levels were broken on Friday because the market just didn't really like the employment situation report. Now, that's the excuse. You can also make a case to say, well, the market kind of wanted to do this anyway. The smart money was selling. We were seeing some weakness under the surface, and that just led to a decline. And now we've switched over and are looking more negative. So we're getting a little bit extreme negative in the short term, but we're really not in the intermediate term yet. The employment situation report, it came in kind of better than feared, but not as good as hoped. And so the market just took that. They could have latched on to anything and used it to rationalize selling in Friday's session. And the initial reaction was rather positive, but then right after the open, selling just came in. Okay. I do have a thing called the SPXInvesting Program. There are additional videos that I post that I don't put on YouTube and Rumble that you have access to on the website. It's currently free, and feel free to check that out. There's a link that will take you to the website there. And this daily video is just the main part of the videos that I do. Now that we're hitting the weekend, there'll be all the other outside videos that I'll be preparing. And none of these videos are really meant to be used all by themselves. They all tie into the daily video and form the bigger picture of what we're looking at here. And this builds in foresight. We can see things develop as they're developing. And then when we see more confirmation of that, that gives us a chance to see things switch right at the right time. So, okay, let's go back and talk about what happened. We had a flat open. Now, the futures were quite negative. We were down about 0.5%. They tried to recover after the employment situation report came out and got back to about unchanged, even went slightly positive. Well, that led to a positive open. We were flat, but it looked like we were going to try to go up right after the open. And we got above the daily pivot at 55.10. So we're dealing with that 5,500 level. But then everything switched. We set the high right after the open, and then the rest of the day was down from there. We declined down below the unchanged level, so that took prices negative. We got down below S1 at 54.74, and we got down to S2 at 54.44. I had S3 calculated, but that's in the 53s. We didn't get down that far. Then prices eventually slowed down. We never bounced up out of that. That's what I was watching for. Is the smart money going to come in and start buying on this weakness? This whole buy the dip idea that I totally don't agree with and don't implement. Well, didn't seem like that was happening. But we did find a support level, and we got just about down to the lower end of the 5,400 level. So we at least stopped declining, and then we chopped sideways and we closed at the low. So we were down 1.73% on above average volume. This is kind of a concern. The market had really been anticipating this, so the volume pickup is not a surprise in that way. But to see downward movement, not a lot of buying, and above average volume. Okay, so we're now negative in the short and intermediate term, but we continue to be positive in the long term. And it's dealing with the employment situation, which is feeding over into inflation and interest rates. This is kind of the last area of holdout to say, okay, the economy's hanging in there. It depends on how you look at it. Yeah, we're adding jobs, and it was not as good as what the market had hoped for, but it's still growing at the same time. And then we want to keep an eye on all the different geopolitical events just in case they escalate enough to impact the markets. Okay, so the employment situation report was not well received. It was not weak, but it was not as good as hoped. The mega caps and semis, they really took things down. These did fairly well on Thursday. Well, they ended up leading things lower on Friday. Oil is still down below that 70 level. And as I've been pointing out, we're watching this for geopolitical reasons mainly. If things really escalate in the Middle East, specifically in Israel, between Iran and Israel, that could really spike oil prices up. The VIX is climbing. We're into that area where we see negative annualized returns. We're above 22 now. And this mass index, it looks like, okay, maybe this was a valid signal after all. It was triggered, my gosh, going back a couple of weeks now. And we don't use that in isolation. We wait for confirmation. Well, we're getting all kinds of confirmation. And we've been going down. And after working off of this one signal and then see more confirmation in other charts. And then we have, and the perma bears are going to love this, and they're going to tout it as though this is real, it's legitimate and everything. No, we have a Hindenburg omen, and the initial signal was triggered actually after Thursday because there's a 1-day lag on this chart, but there has to be a confirmation signal for this to actually be confirmed. And like I said, there's a few perma bears that I kind of glance at their emails and glance at what they're saying, and they're all hot and bothered and just salivating, thinking that, oh, this is it, baby. And there's other things that they're also latching onto, using that as the basis for their entire conclusion. And they may be right, and we may be due for more of a decline than what we've seen already. But to just permanently have this bearish idea is just beyond me. There are times when the market goes up, about 70% of the time, 30% it goes down. You need to be a realist and realize, okay, these things happen. This is normal. This is how markets operate. But this Hindenburg omen, and I'll show you the chart later, it has 20 trading days to be confirmed, and that will be October 3rd. All right, then our short-term list, we're starting to get oversold. These are our usual suspects. Usually it doesn't mean that we're necessarily oversold. It just means that, yeah, look at all these indicators. We have good momentum or pretty significant momentum to the downside. With the Stochk RSI, the Williams percent R, the CCI 14, the 20 is not on the list yet. The force index, stochastics, and then the boom indicator. We're getting kind of far away from that 20-period moving average, which just a couple of days ago was acting as support. Now we've moved so far away from that, we're actually getting too far away from it. And then in the long term, and this is a longer term indicator, even though it's based on a 10-period moving average of the highs, lows for the S&P, it takes a while for this to adjust. It's still extreme positive, but it is coming down. Intermediate term, we have the Connors RSI, which we don't see very often, and I'll show you that chart. And then there's one part of the PMO studies that are looking extreme negative now. Nothing in the long term now. We're back underneath those lines for the 150 and the 200-period moving averages. But the scenario that we're going with is that, yeah, okay, the Fed is going to cut rates in September, and they've said that. How much are they going to cut them? And this is the debate that's going back and forth. 0.25% or 0.5%. And that's going to go back and forth where everybody thinks they know the answer and they get real dogmatic about it. We just have to, we'll look at the charts over the weekend here and show the probabilities and just kind of say, okay, the Fed has some latitude to do some movement here and it's going to impact the market. The dollar was up, and that's been bouncing up a little bit lately, but interest rates continue to go down. We're at 3.71 with the 10-year yield, where after Thursday, we were at 3.73%. So we didn't fall a lot, but this 10-year yield, a lot of the predictions that I've been seeing and people that I actually respect, that I listen to, they're in the 4 to 4.25 range. Well, we're down into the 3 3/4 range now. So It's getting down a little bit more than what they had anticipated. And now this is kind of a big deal because for over 2 years now, since June of 2022, we finally have the 10 to the 2 year back to being normal or uninverted. And I have some charts later on, and I'll show you that. And over the weekend, folks are going to really pick up on this. They're going to make their doom and gloom videos and put them out on YouTube and Rumble, and they're going to make their statements. And they could be right, but to just say this is going to happen, we have to look at all of the evidence together and not just make some conclusion based on one or two little things that we're seeing. But the 10 to the 3 month, it still has a ways to go to get back to being uninverted again. Sentiment is now going down. We are negative, where we had been neutral at 47. After Friday, we are at 39, which is now negative again. And then we're still not trending. Now, in the short term, we're almost there. The ADX is trying to come up above its moving average, and the red line's on top. So I'm suggesting here that we see a developing negative trend, but we're just kind of getting going with this, which might suggest that there's more room for this to run to the downside. But for right now, on the intermediate term chart, which is the one we use to really make our decisions on, we're still not trending, but we are negative and we're below 20. So it's suggesting that we're possibly starting to shift for right now. And with the down day, our bias is negative, and then the last number of days together, that's our momentum, and that continues to be negative. Okay, so we had the non-farm payrolls. Showed okay numbers here, 142,000, but they expected 165,000. And the market said, okay, we're going to treat this as negative. Now, one thing that's interesting here, a month ago, we had 114,000 jobs, and the market freaked out over that. Well, it was revised down to 89,000 jobs. So that's looking back, showing that there's even fewer jobs than what caused the market to really have some problems at the beginning of August. So you can see where you take all of this number right here, and that produces more of a negative scenario. The non-farm private payrolls also came in weaker than expected at 118,000. They expected 142,000, and this number was also revised down. We first heard it came out at 97,000. It was revised down to 74,000. So a lot fewer jobs than anticipated, and this kind of really fed into the negative backdrop. The average hourly earnings were up 0.4%. They expected 0.3%. They could have latched onto that and took off to the moon and said, okay, people are making a little bit more. That'll be good for retail sales. That'll be good for the economy. But then last time it came in at 0.2%. Unemployment rate ticked down. This will be the headline number. This is what the financial media and politicians will really latch onto, even though this is a very manipulated number. It came in at 4.2%, which is what was expected, where last time it was at 4.3%. So you're going to have politicians out there saying, well, unemployment ticked down. Well, vote for me. Look at things are getting better after all. Well, okay. Then the average work week, this was unchanged according to what was expected at 34.3. It was up from the 34.2 that we saw last time. Okay, so here's a few charts. Non-farm payroll change, where it was positive, but they had expected it to be a lot higher, and the previous number was revised down. Unemployment rate ticking down. Again, take that for what it's worth there. So when we compare it with Thursday's data, we have the initial claims, that's in red, are declining, and the continuing claims are declining, and the unemployment rate is declining. So you could look at this and go, wow, things are not looking so bad. Then the average hourly earnings here on a year-over-year basis are ticking up, and they're just a little bit under 4% in that regard. And now we look at this, and this is what a lot of the perma bears are kind of latching onto here, and I'll address this later as well. It says the 5 percentage points unemployment rate increase is nearly always predicted a recession. Okay, There's this thing called the real-time solemn recession rule, developed by somebody not a long time ago. This is somebody who's active on Twitter or X. I follow this person, and they did a lot of research. And when this goes to zero point 0.5 or above, looking back here, anytime that has happened, it has triggered a recession. Now, some lady, turns out, has actually said, well, maybe this shouldn't be taken as serious this time because of everything that happened back in 2020 with the stimulus and shutting down the economy and the lockdowns and all that stuff. Well, it's still coming in over 0.5, and the perma bears are going to pick up on that, and they could be right and just say, well, yeah, we're going to go into a recession. And all the doom and gloomers are going to come out over the weekend and pretty much declare that we're going into a recession, which may end up happening. But there are lots of different things that we look at, and we don't want to just take this in isolation. Okay, so here is the chart. And I usually just show this in the weekly video, but I wanted to show it here because it's been updated. We're at 0.57 now. We're above this red line, and that starts to produce a concern. And you can go all the way back into the 60s and see when this gets above the red line, that typically means we will go into a recession, which again, we can't either rule that in or rule that out. There are charts that we look at that are still looking pretty solid, suggesting we will not go into a recession. There are other charts, including this one that we look at, that suggest we might go into a recession. Okay. Then here, looking at the buybacks, they are dropping off just a little bit here, but they're still pretty healthy overall when you compare it to the S&P 500. And then most years have a few bad days. Well, gee, yeah. And this was before Friday's move, and this is measuring the 2% declines that we've seen. The average is just under 6 trading days every year, going back to 1950. And then risk-adjusted real yields, that takes inflation into account. And this is just suggesting that treasuries, and we're seeing them really improve here based on price, and yields are going down. Where 2022 was one of the worst years for bonds ever. Now they've been more attractive as we've been coming back up. And these are actually looking a little bit more attractive than stocks, which could help things because when folks come in and they buy bonds at different maturities, that pushes prices up and it pushes the yield or interest rates down. Okay, then corporate client buybacks in the S&P 500. The trend is pretty much flat right now, but then we look at the 4-week average where it is coming in down a little bit on a year-over-year basis, as well as the buybacks are pretty much flat year over year. Okay, then the cash allocation down at 11%. This could actually be kind of negative. This means that not very much money is in cash right now. It's being put to use in the stock market. So a lot of folks are invested. And if we continue to go down, they'll probably be selling, and that could really feed more into a decline. And then big data measures of job growth have been mixed to softer in August. This takes all the different measurements that we look at. And this was before the employment report came out. And just showing, okay, we're still seeing growth here and the consensus and all that stuff here. That's the positive side. The negative side is these numbers have been weaker than what economists had been expecting. All right, then another chart here, and we follow this very closely. This is put out by sentimenttrader.com, an excellent website with lots of interesting charts and studies and gives you lots of different perspectives on what's going on in the market, where we do a lot of analysis between growth and value. And right now, according to this chart put out by Sentiment Trader, it's now favoring value. And I'll show you charts coming up after this that will also confirm that. And that's a more defensive strategy. When we want to buy low and sell high, we get into growth. When the market's getting more defensive, that's when the smart money gets into value. Doesn't mean it won't go down, because there's a lot of money managers out there and mutual funds and even ETFs. They have to be invested all the time. They can't just plug their money over into cash like Warren Buffett has done with all of his, a lot of his money. These folks have to be invested. And so what's going to do the least amount of damage, or what's actually has a chance of going up if the market does become more defensive. And right now we're seeing that switch over into value. Okay, and then Walter Deemer, he's kind of a clever guy who's came up with some clever sayings over the years. This is one that I use in my class. I just happened to run across it here. It says, when the time comes to buy, you won't want to. And I say that over and over and over. I put a real emphasis on opening positions, whether they're long, which means we hope they will go up, or short, meaning that we're anticipating things going down. Rarely is it ever going to feel like the right thing to do at that time. If you wait until you feel right and you have this instinct or intuition about it, you're pretty much too late at that point. That's why we look at so many different things and we analyze so many different aspects of the market, because we use this all together in a consensus approach, and it's served me well. I've had consistent success now for decades doing this, and I challenge anybody, just bring up a chart of the S&P. I've been posting videos on YouTube and Rumble for a couple of years now. Look at a chart of the S&P, see when we were hitting highs, see when we were hitting lows. Go back, those videos are still on the channel. Go back and check out and see what I was saying at that time and tell me where I was wrong. Now, I'm not saying that out of a sense of pride. I'm saying that out of a sense of confidence, that you use the approach that I've developed and you can have a lot of confidence on what's going on. It's not the fast answers. You can't just, oh, I'm going to watch this 3-minute video here and get everything I need to know. Those people don't last very long in the markets, and they're fools, quite honestly, to think that you can just look at one or two different charts and get everything you need to know. It's what you don't know that will kill you in the financial markets. And that's why I look at so many different things. But when we're looking at this on an emotional level, looking at the charts, I come up with hunches all the time. And I'll tell you, I'm pretty much wrong pretty much all the time. If I did things based on how I felt, there would be no success, and I wouldn't even be doing these videos. But when I do things based on the chart and I'm like, okay, I'm not too sure about this, but these are what the charts are telling me, that is what has led to the consistent success of really seeing things start to develop before they actually happen when it comes to the markets. Anyway, I don't know why I went off on that, but okay, then the change in liquidity, this could be dragging down the market a little bit. Put out by Real Investment Advice, the S&P has been going up. That's the black line. The red line is starting to trail off here, and that could put some pressure going forward. At the time this chart was posted, they said, well, it hasn't really caused a problem yet. Well, maybe it's starting to do that now because this chart's a couple of days old. All right, here is our intraday chart where we look like, okay, maybe we're going to get a positive open. We got above the daily pivot, and that set the high within the first 10 minutes of the market being open, because each one of these bars is a 10-minute bar chart or a candlestick here. And we got above the daily pivot. That was it. And then the rest of the day, we just went down. We dropped below S1. We got down below S2. S3 was way down here. We didn't get close to that. The encouraging thing is we kind of settled down. This was a pretty orderly decline. It wasn't necessarily based on panic here. But we did establish a low. We'll see, is this going to turn into some kind of a base that the market can come up out of? But we're coming down to the 5,400 level, where we were dealing with 5,600, 5,500. Now we're starting to deal with 5,400 here. And we did close pretty much at the low for the session. So yeah, it's negative in that regard. Here's the intraday chart for the SPY, where you can see right before the market opened, we came back up. We had been quite negative, and after the report came out, we came back and actually went positive there, but that didn't last very long, and then boom, we just went down after that. Okay, this is something that we've been watching for quite a while now, and this is causing for concern. This also goes into the sentiment trader chart with the red line. Even though both of these are declining, the red line is above the blue line. Yes, they're on different scales, but when the blue line is above the red line, that means growth is outperforming value intraday. Also, this is something that's been developing since about August 20th or 21st or so. We topped out with the growth to value ratio intraday with the SPY, and we've been declining ever since. We did see a little bit of a bounce up here this past week, but nothing to really change the overall downtrend that we've been seeing. Our end of day charts, growth just got hammered, down 2.19%, where value was down, but down a lot less. It was down less for the mid caps and also down less for the small caps. So it was large cap growth that just got hammered on Friday. So coming down here, when we look at the end of day small cap growth to value ratios here, and we're also declining with the mid cap growth to value and the S&P growth to value. This is not what you want to see in a more positive environment. We're still below the rainbow. When we look at the growth versus the value ETFs here, we declined 0.76% with this ratio, and this is starting to show some weakness, and some of the lines in the rainbow are starting to roll over. And discretionary to staples was looking better. Now, not so much, as this ratio is coming back down. Large cap growth, it was hanging out above its 100-day moving average. Now we're starting to deal with the 100-day moving average with the S&P, but we've already broke below it now with the large cap growth ETF. And our trend, this is where we're starting to see subtle changes here. We're turning up with ADX, but we haven't quite crossed above the moving average yet, and we're still below 20, but the red line's on top and going up. So we default to negative, and this could be the beginnings of a negative trend, where we're already starting to see a cross above the moving average in the short term here with the ADX, with the red line also going up, but this is still below 20. And we did see a pickup in volume, but lately, a lot of the volume has been below average as the market was anticipating Friday's session. All right, here we're coming up above the moving average here with the Ulcer Index. That means fear is increasing. We're going up well above 20 now with the VIX, with the line chart, as well as the bar chart. And when it's up, the VIX of the VIX also goes back up as well. So the volatility of the VIX is picking up. The momentum of the VIX is also going up now as stocks have been under pressure. And this is the seasonal chart. I've been showing this for, my goodness, at least a week or two in the videos now. This is not necessarily a surprise. As long as we see the VIX continuing to go up, that may mean that stocks are under pressure. And even though we came down a little bit with the SKU index, which is a relative of the VIX, because the SKU index uses out of the money options to do its calculations versus the VIX using at the money options, we're coming down, but we're still in this red area. So maybe this big move that the market is expecting is not necessarily over yet. And then looking at the euphoria meter here, it was getting pretty high. And this is another sentiment gauge that we look at. And this suggests that maybe folks were a little bit too happy about things. And we're going back up with this fear gauge. We're also going back up with this other fear gauge. So we're seeing more confirmation there. The equity put call daily chart actually came down when we look at the ratio. There was a lot. This really spiked up before the report. So they got in on Thursday, and then they were hedged, and maybe they closed out their hedges here on Friday. But when we look at the 5-day and the 10-day chart, they're continuing to go up, which is more negative for the market. We want to keep an eye on the spread between risky and not as risky bonds. Not as hard to really tell from this chart. This is a breakout in an inverted version where we're ticking down a little bit here because bonds have been really doing pretty good here. But we're seeing higher readings than what we were seeing before. As this goes down, that just means that fear is actually going up. We want this to go up. That shows that fear is going down. And then just to give it a little bit of context, I show the S&P in regular form here, and then an inverted version of the VIX. Okay, we're continuing to go down with the risk on versus risk off. That just means the market is getting more defensive right now. And large cap growth versus small cap. And it's not that large caps outperformed, even though this ratio went up slightly. Small caps got hammered on Friday too. And so they did a little bit worse. And so this ratio actually ticked up slightly. And we're coming down. We're still in the band. We actually dropped a little bit here with the volatility risk premium. You would have expected that to go up, but it actually went down. All right, and then we're seeing some weakness here with the advanced decline line based on price and volume, but we're still above the advancing moving averages. So this hasn't fallen off a cliff, at least yet. And we're seeing some deterioration here with the new highs minus the new lows. The new highs are dropping off. We're seeing a bit of an expansion of the new lows. We're going down now with the 5 period and the 10 period. The advanced decline ratio, declining but still above zero, both with the 19 and the 39-day moving averages that we use here. So we're declining but still above zero based on price with the advanced decline ratio. We've already dropped below zero based on volume. And that was a concern. We were seeing volume not really helping price to go higher, but now that we're going down, we're seeing volume potentially leading price lower. All right, then we look at the highs minus the lows for the S&P, still getting a positive answer here. Just barely, but we are still positive. And then we look at a 50-period moving average of that, and that's continuing to go up. Now, if we see more weakness and this drops below zero, eventually this red line is going to turn and start to go down. And we look at the 10-day average of the S&P highs minus the lows, coming down, but still above this extreme positive reading. And if we continue to fall, this will eventually drop as well. And then looking at the cumulative S&P advanced decline line based on price, we're declining, and see how we're going a lot quicker now based on volume. That's a little bit of a concern. And we're coming down here both with the S&P and the NYSE advanced decline line. And I plotted a 50-period moving average here. This is of the NYSE advanced decline line itself. And so these moving averages here just say, okay, the advanced decline line's been in an uptrend, and we're coming back down to this 50-period moving average now. Accumulation distribution, we have now switched to negative here. This is a smart money indicator. We've dropped below the moving average. According to the boom indicator, we're quite far away from the moving average. I don't think we're all that far. We could get farther away than what we're seeing right now. Shaken money flow starting to turn down. It was actually looking better after Thursday. It went up, but it really declined on Friday enough to start to move the red line, the moving average, down. So this is now turning negative. And the Chaikin oscillator below zero and declining, also negative. So our smart money indicators are now negative. And here's another primary indicator with the red line above the green line. That has just, it switched over after Thursday. It continues to be negative after Friday. And we're falling down here a bit with the NYSE cumulative advanced decline line. And we're also declining, but still holding up okay above the moving average with our regular NYSE advanced decline line. Also, this is a slightly different calculated NYSE advanced decline line, coming down, but still looking healthy overall. And we look at the common stock based on price on the NYSE coming down. Now, this is actually kind of encouraging because we're declining based on volume, but not with as much intensity. It's the S&P volume that we're getting a little more concerned about. And we are declining with our advanced decline line studies, but we're still above the moving average with the NYSE common stock. The S&P, we're coming close to the moving average with the mid caps, and the small caps are starting to drop below the moving average. Our short-term chart, we fell down below the 50-day moving average. That was a major moving average we were following here, and we did go above average with volume, and we're declining with the 20, 50, and 200 period moving averages on the S&P itself. The condition of our 20-period moving average is deteriorating. We're seeing the lines starting to come back down, and we're well below the simple and exponential 20-period moving average. This had been holding up as a level of support. Well, we lost that on Friday. That has definitely switched the short term now over to negative. The boom indicator, though, we saw a pretty significant decline here, so we're getting kind of far away from that 20-period moving average. And we're extreme negative with the Stochk RSI, the Williams percent R. The CCI 14 is extreme. The CCI 20 is not, but it is declining. It's negative. And the force index is looking a little bit extreme here. It's coming down to the lower Keltner band. So on a short-term basis, you could make a case that we've gone down pretty far, pretty fast. The short-term stochastic, extreme, intermediate, extreme, we're now negative and no longer extreme positive with the long-term stochastic. Coming down, but not extreme here with our standard deviations chart. We're in the -2 channel. It's when we get into the -3, that's when we start to look extreme. And after just a week ago, I was harping on this saying, man, look at that 20-period moving average study. It's so extreme positive. Well, it's dropped enough now to go below 50 and has actually turned negative. And we're coming down after seeing some good strength here in the short term. This is really showing some weakness as well. We're declining, but still above 50 when we look at the stocks above their 50-day moving average, declining with the 100 and also declining with the 200, but both are still above 50. So they're maintaining a positive backdrop. Intermediate term, we have now gone negative with the balance of power. We drop below the midpoint. This is the Connors RSI, which is a momentum oscillator. And this thing just gyrates all over the place day in and day out. We don't see many extreme positive or negative readings here. Well, now we're starting to see an extreme negative reading. This is the condition of the 50-period moving average dropping below the lines, and both the blue line and red line are starting to go down. And then we look at the go, no go. This is brown, or I don't know if they call it a different, I'm calling it brown, but that's turning negative. And we're dropping below the lowest low value here, which is the red line. That's turning this more negative. And where you fell below this anchored moving average, this was going back to a high, or excuse me, a low set earlier in the spring. And actually, yeah, later in the spring, and then another low that was set earlier on in the spring. We're dropping below this initial anchored moving average and now possibly coming down to this other anchored moving average. And the TTM squeeze is no longer extreme positive. It's now turned negative with the dark shade of blue. And we're starting to see the standard deviation, which measures speed over the last 10 periods. It's starting to really pick up and go above its moving average. We've turned negative now with the ease of movement. The Arun just still is on vacation. And the S&P McClellan oscillator went below zero. That turned things negative, and we are coming down, and not necessarily extreme, at least yet. So we're turning down based on price and volume. We had been seeing a divergence here where price was going up, volume was going down. Now they're confirming each other to the downside. And we're below zero and declining with the NYSE McClellan oscillator. So we're starting to roll over with the NYSE summation index based on price and volume. The Swenlin trading oscillator, we were seeing a bit of a negative divergence here. We were declining based on price, but still positive. Well, now we drop below zero. So it's negative, and we're also declining based on volume and negative. We're starting to turn negative with the momentum. The PMO is now crossed below its moving average. We're below the moving average based on price and volume. And we're a little bit extreme here with the PMOs that are rising, looking a bit extreme negative. Here, the buy signals are declining, and after giving us a solid reading, the PMOs above zero are starting to decline. And we are negative with the Elder's Impulse system for the S&P. We're negative with the parabolic SAR. We're negative with the slope oscillator and no longer extreme positive. The MACD is crossed below its moving average and is now negative. So we look at the short term, we're negative. Intermediate term, we're negative. We're rolling over, but haven't quite crossed over negative with our longer term oscillators. The copy curve oscillator is now negative, and we're dropping below the 50-period moving average. This was a support level that had been holding there for a couple of sessions. Well, we fell below that. So now we're going to keep an eye on the 100-period moving average. We're still above that. So we'll see if that ends up providing some kind of support. And this is more intermediate to a little bit long-term. The really long-term I use is the 200-period moving average, and we're still well above those. So here's all the different moving averages here. We broke below the 20 and the 50, and now we're coming down to the 100. We're declining, but still neutral here with the Sean trend meter. And this is encouraging, though. The bullish percent index declined, but it's not falling off a cliff right now. So a lot of the stocks in the S&P 500 are still holding up. We're declining, but still holding up with the NYSE bullish percent index. But we're now negative with the NASDAQ 100 bullish percent index. We're dropping below 50 with the money flow. That's now negative. We're continuing to decline below 50 with the ultimate oscillator, which is negative. We're crossing below the moving average with on-balance volume. That's turning negative. And we're below 50 with the RSI 14 and 9. You could also make a case that we were making highs here as the S&P was going up and pretty much matching these prices, even though we didn't set a new all-time high, but we were seeing lower readings. Now, some of this is because of the way the indicators actually calculated, and it can't help but negatively diverge, and this ends up being a self-fulfilled prophecy here. But we're starting to see more weakness here with the RSI, and a lot of people use this indicator. Mass index, that's kind of, looks like it was a legitimate signal. It took a while to kick into gear, but we're still working off of this signal that was suggesting a reversal. And so we're breaking below the 20-period moving average support. We had this little mini rainbow thing. It was holding up. Well, after Friday, it's now broken down. What we'll be watching for now, if we stay below these lines, the lines will actually start to turn and roll over. We're still positive here with the Ichimoku cloud, even though we're coming down into the underside of the cloud, but the blue line is still above the red line. It's coming down and it might change, but it hasn't quite crossed over yet. And the green line, which is really hard to see here, is also coming down. And this is more negative longer term. This is a weekly chart of the S&P 500. We had been above this R2 level. In Friday's session, we closed down below that. So this is another longer term support level that has now been lost. And we're coming down here, getting close to this 38.2% fib extension level as price has been declining. And we're looking negative here with the Heiken Ashi, with the dark candles. We're negative with the Kegi, and we've actually switched over to negative here with the Renko chart and the three-line breakage chart. Three-line break chart is now negative as well. And just enough of a downward move to put in another O after Friday, but no signal has been generated yet. So this is also more negative. Long term, no longer extreme with the 150 or the 200. And we're still negative in the short term. We're starting to switch over to the negative side of things with the NASDAQ 100 in the intermediate term. So stocks are negative, negative in the short term. Bonds are still positive based on price across the board, where commodities and the dollar continue to be negative across the board. And everything got hammered except real estate, and it had the best day, and it was unchanged. Where everything else got hammered, and the three growth areas, tech, discretionary, and communication. These got hit the hardest, and this is growth versus value, and they saw the most weakness. Awful lot of red, few little blue things in here to make it kind of a Christmassy thing here. But we just saw an awful lot of damage, especially with the NASDAQ dropping below certain levels. We had a BPI cross below 50. Now, I show the NASDAQ 100. This is the NASDAQ. So that's turning more negative as well. And the Dow, which just a week ago set a new all-time high, had a bearish MACD crossover, and even Canada showed a little bit of weakness on Friday. And we're coming down with both, but not really seeing anything leading right now when we look at the S&P and equal weight S&P. And we're coming down here a little bit as the mega caps and the large caps underperformed. So this ratio did decline slightly here. The new highs, new lows for the NYSE were declining, but we're still positive. On the daily chart, we also take a much broader look here across a 5-period moving average of the highs minus the lows. We are coming down, but we're still positive. And this suggests that the broader market is at least holding up for right now. Now, it could turn and get more negative as well, but for the time being, it's still holding up. We're getting close down to the 50-period moving average with the Dow. We are negative with the Elder's Impulse system for the diamonds, and we just continue to fall below this pivot level here for the NASDAQ and the NASDAQ 100. Are we going to come down and test the 200-day moving average? Both here with the NASDAQ and NASDAQ 100. Still a ways away, but so was Friday's price before Friday happened. So we'll have to see if this ends up providing some kind of support. And we're negative with the QQQs, with the Elder's Impulse system. We're negative with the momentum of the NASDAQ 100, dropping below the moving averages here with the QQQs, possibly coming down to the 200-day moving average, and just dropping all the way back and getting close to a full retracement here with the fib extensions chart for the Qs. Small caps, this was an area I was watching on Friday because we closed right at the 50-day moving average. That blew right through that in Friday's session. We are negative with the Elder's Impulse system for the small caps. Also watching the 50-period moving average with the Russell 2000 small caps. We're declining with the RSI below 50. We're below the 50-day moving average, and the momentum is negative. And looking at the small caps to tech ratio, this continues to go up. Even though small caps didn't do very well, tech did even worse, and that's why this ratio is going up. And the mid caps falling below its 50-day moving average for the second day now. And we're negative with the Elder's Impulse system for the mid caps. And we were holding up here. This was another area I was watching. This is a broad market measure, the Wilshire 5000. We closed right on the 50-day moving average, which would have been a good level of support had we gone up. Well, we broke below that on Friday. Another thing, the total U.S. stock ETF. with 2,651 stocks in it. We were right at the 50-day moving average. We fell down below that. So that's more of a broad market negative sign that we're seeing there. And the staples to tech ratio continues to go up as staples are outperforming tech. That's defensive. The FANG index was also down over 4%, but still above its 50-day moving average. Now, when we fell down there on that big down day in early August, we came down to the 200-day moving average. We're going to be watching that if we see more follow-through weakness. And we're dropping below this shorter term and longer term trend line here, and trying to figure out, okay, where am I going to put the next trend line? Maybe a shorter term one going this way, but we're not quite there yet with this. But this is just showing that the FANG index is also losing support based on this chart. Apple was down 0.7%, down to its 50-day moving average. We have Amazon dropping below its 200-day moving average, and Google below its 200-day moving average, and Microsoft below its 200-day moving average. Meta coming down and falling a bit below its 50-day moving average. NVIDIA is kind of in no man's land, but dropping below its 50, but still above its 200 moving average. Tesla, after breaking out above its 50-day moving average, is now coming back down, and we're still in a longer-term uptrend as measured by the moving average crossover here. Netflix has come down still slightly above its 50-day moving average. Oil, we're watching this for geopolitical reasons, falling further under 70, coming in at 67.67. And seeing the U.S. versus world stock relationship starting to get a little bit stronger on a short-term basis and pretty much even now on a longer-term basis. And the dollar ended up being up, but we're still in a downtrend here. And we're coming back down below this trend line with a 3-year chart of the dollar. So we continue to fall. Now, this is interesting. Where we opened, we had this is like a doji in candlestick talk. We opened and closed at just about the same point with a pretty wide bar here. Is this going to suggest some kind of reversal? We'll just have to watch things unfold. And we're continuing to go up with the 7 to 10 year based on price, but closed well off of the high. Here is the 10 to the 2 yield curve. Have not seen this in over 2 years. We actually have switched back to normal now. We're getting a reading of this at 0.06. And it actually closed that way. There has been a few times over the last few weeks when it ticked up enough and intraday it went back to uninverted, but this is the first time in over a couple years it's closed uninverted, which means it's going back to normal. What a lot of folks are going to be doing is this is going to start the countdown to see if we're going to go into a recession. And just take your pick of doom and gloom videos and newsletters and blog posts that'll be posted about this. This is what it looked like after Thursday. And they actually said it went back into positive territory, not based on the chart I saw. We were just still slightly inverted there. That's like splitting hairs here, but we are now above this line according to this chart. And then the median path of the S&P around uninversion, when the 10 to the 2s become uninverted again, what happens? Okay, recession within 12 months or after. Okay, that's one thing that we're looking at here. We have to keep in mind the context. Is the economy falling apart? Where here you have no recession within 12 months after uninverts. Okay, but we need to look beyond just this chart and say, okay, why are they cutting rates? Because inflation has been coming down. Employment's still hanging in there, not as strong as people would like, but maybe that'll help the employment situation improve a little bit. It's not necessarily because the economy is falling off a cliff. Now, that could change. And the scenario that we're coming up with right now may switch to something else, but we have to go with what we're seeing right now. You can come up with all the crazy predictions that you want. We just have to look at what's actually happening. Okay, and then growth to value, not looking good. And this is feeding more into this. Value is now looking a little bit better than growth with the Qs to S&P going down. We're seeing some improvement when Tesla had a really good day on Thursday. Well, that's coming back down a little bit, but this is actually looking the best right now. And large cap growth is underperforming large cap value. So we're going down with the large caps, mid caps, ticked up a little bit, but still looking weak with the small cap growth to value. And we want this to go up. This is going down. When we look at the S&P to utilities ratio, we want this to go down, and it's going up when we look at the staples to S&P ratio. Now, here is the Hindenburg-Ullman. And if pause this, and if you're having trouble sleeping, read through this. You'll be out in 38 seconds. Okay. But this is the actual chart. And what stockcharts.com does is they take three different criteria and put them together into one indicator that you can post on this chart. And you can see other times when we had a confirmed Hindenburg-Ullman here, yeah, it spelled some real trouble after that. Well, we had a few single signals here in 2024, but no confirmations. Now we have the initial signal. Now, please, again, the perma bears are going to say this is a done deal. This is already happening. We have to get another spike up by October 3rd, which is 20 trading days after September 5th. That's when it will actually be confirmed. And when we get a confirmed Hindenburg-Ullman, yeah, things might look pretty dicey. But we've seen these before. And the NASDAQ has been getting all kinds of Hindenburg-Ullmans and even confirmed ones, but it was still going up. So there's no infallible indicator here, but we just respect this because I dismissed this for such a long time because it's a perma bear type indicator that they get all hot and bothered about. And I tend to dismiss most of what they say anyway. And then I noticed that stockcharts.com had this ability to set this up. And I'm like, okay, maybe this is something we should at least pay attention to after all. All right, so what's our outlook for Monday? We are negative and falling below support. Now, we're still above the 100 period moving average. That is support that's still below current price. But we fell below the 20 and the 50, and that's what we were watching for Friday's session. We're going to get wholesale inventories and consumer credit on Monday, and then anything crazy that could happen geopolitically that might impact the market. Here is the economic calendar for the upcoming week. The big one is going to be Wednesday. We're going to get CPI. On Thursday, we're going to get PPI. And then on Friday, we're going to get consumer credit or consumer sentiment. And nothing marked yet because the big important reports won't come out until Wednesday. Seasonally, not much of an edge either way here for September 9th. Neutral to positive with the Dow and NASDAQ. Neutral to negative with the S&P 500. Excuse me. All right, then here is a seasonal chart coming up into the 9th. We do see some weakness here with the during an election year for the S&P. This is going down. And then Monday, though, is the most positive day. At least it was back in 2023. And then so far in 2024, it's been positive, but not the most positive day on Mondays. And then the first part, this is kind of interesting, where it says, yeah, the first part of September looks fine, but the second part falls apart. Well, we're kind of seeing the first part not looking so good right now. And then comparing 2024 with 2023 and how we're looking here. And this, if you remember it, a year ago, we were going down. I was getting all kinds of comments and emails saying we're switching over. The market's going to just fall apart. Well, we ended up finding support. And just about the time I start getting those comments and those emails, I know we're pretty much finished at that point because people are doing things largely based on emotion, where we had a whole lot of charts saying, okay, we just might be done. We have a shot at being finished with this decline. Is something like that going to happen this year? And then the warning signs. Our smart money indicators, they're over on the negative side now with accumulation distribution, the Chaikin money flow, and the Chaikin oscillator all switching over to negative. We're keeping an eye still. And we've been watching this for a while, and this was setting up, and now it seems to be playing out with the more defensive sectors like staples, utilities, and healthcare. We're watching energy, specifically oil, more geopolitically. And the equity put call ratios for based on 5 and 10 days are going up. That's negative. And the S&P as well as NYSE McClellan oscillators and summation indexes are negative. Parabolic SAR, oscillators, except for the long term, we've already switched over negative in the short and intermediate term. Money flow, the ease of movement, the Swenlin trading oscillator, the momentum for the NASDAQ 100 and the bullish percent index, the ultimate oscillator, the Copic curve, the vortex, these are all negative now, and growth to value as well as discretionary to staples, just not really helping the market to go higher currently. Positive signs, kind of getting short. The advanced decline lines, they're weakening, but they're still holding up. Now, we've already dropped below the moving average with the small caps, but we're still above it with the S&P. And we're still, this is actually kind of encouraging. The S&P and NYSE bullish percent indexes, they haven't rolled over. They've declined, but they're not showing an awful lot of weakness, at least yet. In the financial sector, it was down in Friday's session, just like everything else, but it's still looking pretty solid. So our conclusion, we're negative and we're losing, and we could already say we lost it because we closed below it. Both short term, that would be the 20-period moving averages, and intermediate term would be the 50-period moving averages. And that's pretty significant support. The market was really using that, and it held there for a while, but then we lost it on Friday. So in the short term, we're negative, and we are becoming oversold, but you could say that's suggesting negative momentum to the downside there. And we're in the process. I mean, we could zip right back up in Monday's session and regain the 20-period moving averages. So that's why I say losing the 20-period moving averages support. And that's both the simple and exponential moving averages. Intermediate term, we're also in the process of being negative and losing the 50-period moving averages. But we're still positive in the long term. Thank you. I really hope you found this helpful. I hope you have a great weekend. If you're a member, you'll have access to this early, right when you wake up Saturday morning. If you're not a member, you won't have access to this until the market closes on Monday. So I hope that you either have a good weekend if you're a member, or you had a good weekend if you're watching this after the close. And I will talk to you in the next video.